Today, we're diving into a crucial piece of U.S. legislation poised to reshape the digital asset landscape. The Digital Asset Market Clarity Act of 2025, often called the Clarity Act. This bill aims to bring much-needed regulatory certainty to cryptocurrencies and digital assets, establishing a clear framework that divides oversight between the Securities and Exchange Commission, or SEC, and the Commodity Futures Trading Commission, the CFTC. Let's break down its key provisions and goals. The Clarity Act defines terms like digital commodities and distinguishes them from securities. Digital commodities are assets intrinsically tied to a blockchain's function, often falling under CFTC jurisdiction for spot markets. Securities, on the other hand, remain under SEC oversight, particularly for initial offerings or investment contracts. A significant aspect is how it creates pathways for tokens to transition. They might start as securities during fundraising, but once a blockchain becomes mature, meaning decentralized with dispersed control, they can shift to being treated as commodities. The bill also includes specific provisions for stablecoins, building on existing laws like the Genius Act. It offers exemptions for certain DeFi activities, such as validation and software development, and establishes anti-fraud rules. Furthermore, it aims to streamline registrations for exchanges and brokers and provides protections for non-controlling blockchain developers. Importantly, it addresses anti-money laundering concerns through the Bank Secrecy Act. Overall, the act seeks to reduce regulatory uncertainty that has often led to an enforcement-heavy approach, aiming instead to foster innovation, protect consumers, and keep crypto activity within the United States. Now, let's look at its legislative status as of January 14, 2026. The Clarity Act, introduced in the House as H.R. 3333 by Chairman French Hill on May 29, 2025, passed the House on July 17, 2025, with strong bipartisan support, a vote of 294 to 134. It's currently in the Senate, where it requires reconciliation between the Senate Banking Committee, which handles the SEC and stablecoins, and the Senate Agriculture Committee, responsible for the CFTC and digital commodities. A full 278-page draft text, an amended and negotiated version, was recently released by Senate Banking Chairman Tim Scott and others. Key developments include a Senate Banking Committee markup session scheduled for January 15, 2026, tomorrow, where they'll debate over 75 expected amendments and potentially advance the bill. This session could address important issues such as stablecoin yield and rewards. However, there are reports of potential delays, with the Senate Agriculture markup possibly pushed to late January due to ongoing bipartisan negotiations and concerns over certain provisions. Recent amendments in the draft notably prohibit paying interest or yield solely for holding payment stablecoins. This favors traditional banks' competitive edge, but still allows activity-based rewards for things like transactions, staking, liquidity provision, or governance. For the bill to pass, it needs bipartisan support in both committees, then the full Senate, likely requiring 60 votes to overcome any filibuster, followed by reconciliation with the House version and, ultimately, a presidential signature. Analysts suggest its passage hinges on these cross-party deals. A failure in 2026 could significantly delay major reform, though some industry wins have come through executive and regulatory shifts. This leads us to recent controversies and potential market impact. The curbs on stablecoin yield in the latest draft have sparked considerable debate. Some see it as directly benefiting traditional banks, potentially affecting how platforms incentivize stablecoin use. Industry voices have mixed views. There's optimism that clarity will boost adoption and institutional inflows, but also concerns about new compliance burdens, increased surveillance, or potential loopholes. Crypto commentators on platforms like X are already discussing its potential to drive altcoin rallies in 2026, encourage institutional entry, or benefit specific infrastructure projects like AAVE, MKR, and SOL. Furthermore, the bill's impact on CBDCs remains a point of contention, as it specifically prohibits certain Federal Reserve actions regarding them. In conclusion, the Digital Asset Market Clarity Act of 2025 stands as the most significant pending U.S. crypto market structure bill. While it has momentum, its final passage remains uncertain in the near term due to ongoing Senate work and complex negotiations. Its impact on the future of digital assets in the U.S. will be profound, making it a critical development to watch closely. For the absolute latest, you can track HR 3633 on Congress.gov.